Hello, traders. This is Blake Morrow with Trader Summit, and with me today I have Mr. Rohit Srivastava from India Charts. Good to see you, Rohit. How are you?
I'm good. Looking forward to another wild year, I think, ahead of us.
Yeah. Okay. Well, I'm glad you're getting right to the point. This year has been full of volatility. We've seen equity markets be under pressure most of the year. How have you been? How have you been navigating this year from your point of view?
So, since I do trade a lot of the Indian market. The start off was not easy because I had to pivot, to use that word, from being in a long only bullish trading market to that. Well, this is not going to be only the one-sided trade. You're going to have to take both sides of the market. So from April on, we switched strategy to doing long and then short and then long and then short. And that sort of then paid off pretty well because we've had, significant 10-15% moves on the downside, then the upside, then the downside. But the Indian market's actually been special because it has meaningfully outperformed the US, despite what has been, a very tough situation out there in terms of how the market and stocks have performed. The Indian Nifty actually hit an all-time high on the 1st of December.
Wow.
So sticking with the bear case was really tough. But we have had those sell-offs as and when US starts to weaken, the Indian market does see a decline, as we have seen through December. But once again, in the last few days, we are seeing a slight pickup, which I'm thinking can continue for a while. And so we are having to navigate the strength of the Indian market in light of what is happening around the world, which is, makes it really, really hard. We start talking about something known as decoupling. In India, we say, oh, have we decoupled? And it's like a bad word because every time someone has used the word decoupling in India, things have fallen apart.
So, well, let's hope that they don't. From a macro perspective, I would think that, as I think India would be a really big beneficiary in the years ahead, as a lot of companies move away from China and use India for a lot of manufacturing. I would think that helps support at least the Indian economy more so, maybe decouples from other world markets, maybe in the years ahead. But I'd be really interested to see your charts and see what you're looking at going into this next year. But before we do that, let me first of all say, if you guys and gals like what Rohit does here, this is exclusive content from Trader Summit. Make sure you subscribe to the channel, give him a thumbs up for being here today, ahead of the new year. And then also, Rohit, when you're looking into next year, are you expecting that same volatility, or what are you seeing?
Yeah, that's the big question. And I think the macro environment has not yet changed. And that's the main reason why we're not able to flip and say India's long bull run has really started. The rub-off of those macro events is not so big on India so far. It's a risk that I'm watching out for all the time. And when I say macro, what I'm really referring to is two data points right now. One is what do bond yields do? Second, of course, the talk of town, which was last year, was the dollar, but more specifically, the dollar rupee cross rate. Because I think we are past the point where the correlation, which was so high with the dollar driving all this volatility around the world, I think because there was a huge policy divergence. The US was raising rates, even as Europe was still doing QE to some extent, and didn't want to raise rates till June of this year. Right now, in the most recent policy meeting, they have flipped on that, saying that they want to tighten. Okay, so that's, I think, one big change. And Japan, while they are still doing some amount of bond buying, has at least raised the peg. And that's, again, a big change. So what that does for a dollar index, which is the cross rate, is that it may reduce volatility of the dollar itself. But when it comes to individual currency pairs, their behavior may be very, very different based on their individual conditions specific to the country itself. So I have to therefore watch my own cross rate rather than only depend on the view coming out of the dollar index. But
Interesting. Yeah.
the other one is going to be bond yields, and that doesn't change. Bond yields have risen in the last 2 weeks, starting with Europe, then in the US, but again, not so much in India. It has been pretty flat in India. But bond yields in India also not going down much. So I'm watching it closely for a multi-year breakout. It's like the Indian bond yields are in a 6-7 year kind of downtrend, and they're on the verge of that breakout. If they break out on the upside, they'll join probably the rest of the world in taking rates higher. And that, I think, is the risk that Indian investors are overlooking.
Okay. Well, do you have I know you're going to show us a few charts. Do you have that specific chart that you're going to show us? Because I think that's interesting, because yields have obviously rallied quite substantially here in the US and in Europe. I'd love to see what they're doing in the Indian market.
So this one shows what ended happening is on the right hand side, Spain, Germany. This is where yields were rising, even Canada on the left.
Yeah.
This is the Indian bond yield. Okay, so while those yields actually broke out, we saw this breakout from a triangle here. These are all daily charts. In India, it's been pretty much in this very tight trading range, in a narrow range between 7.2 at the bottom, 7.5 at the top. And I'm really waiting for it to break out of this range. Now, if I take a slightly longer term chart, what I was talking about is the 7-year range. Okay, so this peaked at around in 2013. From where there, it was in a downward channel. It's been attempting this breakout. Now we are right at this point, gyrating up and down above this channel line. Okay, and what I'm watching out for is, does this consolidation eventually result in higher bond yields? And I think we do eventually follow the global bond yields. So if global bond yields are rising, at some point of time, this is going to give way. The RBI, or the Reserve Bank of India, has been trying to keep this volatility down. But moment you break out of this upper line at 7.5%, I think you're headed towards around 8.6, maybe even 9% on the upside, where wave C and A, I'm taking this as a big ABC on the way up, will complete. Now, why am I taking this as that? Here's I'm switching to a line chart so that it shows the pattern more clearly. We're actually looking at a long triangle developing between 2007 and 2020s. Okay, so we had yields peak out in around, I think, 1996 in India. They had really gone to double digits, almost 16 to 20%. And then they came down from there. I think the G-Secs would have been at around 15%. And then they came down from there all the way to around 5-6%. So it was a huge cut in rates, which sort of stimulated the economy, I think, in 2003 to start its bull market. And since then, we've been in a triangle. So these are various legs of the triangle that I'm showing here: wave A, wave B, wave C, wave D, which I think is completing inside this channel. And wave E should actually be the last spike. So now when I say it is the last spike for long-term investors, 1 year down the line, once this last spike is over, there's actually a great investment opportunity coming up here. When bond yields peak out and they actually start a long duration decline. This is what I'm seeing as the opportunity. But we are not there yet.
Okay.
We are not there. So the bull market you were talking about, I do anticipate, but only after we are past this point of inflection or fear or panic.
So you think that the initial rise in Indian yields is going to put some downside pressure on equities and risk in general in India?
That's right. I think valuations in India actually being elevated. There are a lot of measures. People have compared Indian valuations to emerging markets, and we are at the highest gap between the two seen in history right now. Okay. So that valuation correction can only happen if there's a move up in bond yields.
That makes sense. So that's a warning. I'm going to say that's a warning that you're giving to Indian investors, at least at the start of this next year. Is that correct?
Yes.
Okay. All right. Well, that's definitely worth noting. What else are you seeing in the bond market before you? I mean, I'd love to see what you were talking about as far as currencies and how you're viewing the dollar.
Yeah. So in other bond yields, I haven't put a number, but most of these triangle patterns tend to be fourth waves. I sense that you're going to see these yields continue to rise for a while. So this, like, I'm zooming out to a slightly bigger picture. So even if I look at Spain or I look at Germany, both are doing fourth waves. And in that sense, you would think these yields can go much higher, So I'm not even, I mean, if I actually think wave 1 and wave 5 equal each other, then the numbers would be pretty big. Maybe 5, maybe 6% on the 10-year. This is Spanish bonds. If I do the same thing on Germany, okay, so we have this long consolidation here, which is the second wave, third, fourth. I'm taking as the triangle, can possibly go to towards 3%, I sense, in this move. We're currently at 2.47.
Well, that would be a pretty big move.
Yeah.
So, how are you seeing the currency market? I know you said, well, I'm, focused. I've been focused on the dollar, but I think, you're going to be shifting your focus a little bit away from the dollar. And can you show us in what sense you're going to be doing that?
Yeah, so I do think the dollar index is bottoming out. The only thing I wanted to mention is that the volatility is really going to contract because everyone's raising rates now rather than only the US. So that reduces the volatility of the dollar as a cross rate. Having said that, on a 10-year basis, we've actually broken out above 100 and 304, this range. And when you have this kind of a long-term breakout, I wouldn't expect prices to really go back below it immediately. And unless they do, my sense is it does bottom out somewhere in this range, close to 103, 104, and then resumes its upward trend. Okay, so I'm trying to think that this is the first and second wave of a ongoing up move. Even if it is not, say, if it is an ending pattern, similar to what we saw, say, in back here in 2001, 2002, it can take quite some time to develop. Okay, so I have two possibilities building up. One is that I maintain that it's an impulse, 1, 2, 3, 4, 5, or it develops into an ending structure where we'll end up marking it as A, B, C, D, E. Even then, there could be multiple, rallies and pullbacks in the dollar along the way.
That would make sense to me, because if a lot of people are forecasting that the first quarter of this next year, we're going to see some recessionary pressures. It's going to be harder on the economy, and to see the dollar outperform, especially the first quarter, that makes sense to me. So finding support down here in the dollar index, I could see that.
Yes. So the whole idea, you're right. The whole idea that the Fed pivots on interest rates at the point where you hit a recession, and then the yield curve starts steepening. That's usually the point at which, if rates start coming down because they start cutting back, the DXY would start to weaken. That is a normal expectation. But that would probably happen 6 months into next year. And so by that point of time, we'll probably see many gyrations on both sides of the trade. And that's what I think we need to be watchful of. Also, sometimes the dollar also reflects not just what is happening in the bond market, but also in the equity market. So if we get significant weakness in the equity market because of the recession, even while yields are being cut, which is how it's historically worked in a non-QE environment, if we look at either 2008, 2009, or we look at 2000, 2001, those bear markets, the point at which you actually recognize that a recession is coming was the point where rates went down and the markets also went down. Yeah. And it took almost 300 to 400 basis points of rate cuts before you got a actual reversal in the economy and the market. So if we stick to that model, then probably rates bottom out much before the markets do. And while markets are still falling, the dollar might not weaken immediately. So it may remain strong while markets are still weakening and only turn around at a later point. So that could be the deviation where we get a lot of those intermarket divergences between these asset classes. But once that's done, I think then the worst is over. So I think everyone's modeling in that 6 months into 2023, the worst is over. And the question really is then, how bad is that worst really going to look like?
Yeah, right. Well, before we wrap things up here, Rohit, what's your view on the equity markets? And I'd love to see your view of the Nifty50 as well, and because I know you do trade the Indian markets quite a bit. So
yeah, so I have the S&P here, and then I'll go to the Nifty.
Sounds great.
So far, my model for the S&P has been that it developed a leading diagonal. A leading diagonal is marked as wave A, which is a 5-wave decline that tends to overlap. Very different from a clean impulse, which doesn't overlap. So in an overlapping situation, when you get something which looks like a wedge, and why I'm highlighting this in specific is leading diagonals are often followed by very, very sharp third waves. Otherwise, you can't say that. But in my experience, at least in Indian markets, I've seen that wave C down that follows a leading diagonal occurs in sometimes in 1/3 the time that it took to form wave A. So wave A here has taken almost 6 months. And if I go by that theory or just my observation, the wave C down, which I think is just getting started. In fact, in one of my previous interviews, I may have mentioned that wave B was over in September at this top, in fact, August, and we had already started down. But it looks like in some cases, the pattern may have extended all the way into November. So there's a variation, either in the NASDAQ, there's a variation. In the Dow, there's a significant variation to the structure, which is why it may be easier to think that, okay, wave B ends in November and C down is starting. Now, C down should be a 5-wave decline. And like I said, it's going to happen in like a short period, maybe 2 months, maybe 3 months, in which we're going to see a 5-wave decline, which should be equal to wave A, but usually after a leading diagonal, it tends to extend, which means 1.618 times wave A. Now, equal would mean giving us a number slightly closer to 3,200. But if it extends, then it might be a number much lower, closer to 2,600. So we're looking at a wave C decline that is quite significant. But it would be in 5 waves. So you'll have wave 1, you'll have wave 2, you'll have 3, 4, 5. It will subdivide with intermittent bounces, but go much lower than what we might generally think.
Wow, that's well, now you just scared me. So what are you seeing with the Nifty?
So on the Nifty, we have a slightly divergent pattern. And I'm going to take a white chart so it'll appear clearer. So you notice, like I said, the Nifty's actually rallied back to a new high in December. This is a weekly chart. And I'll just go to a daily. Okay. So what it ended up doing is, while it was declining with the US market into June, at that point of time, it started to diverge. So you have this long triangular expanding pattern into the low of June. And at that point of time, we had huge short positions building up from institutional investors. And what we have then seen is a short squeeze. In fact, we had a short squeeze at both points. Huge shorts built up here. Huge shorts built up here. I think that happened purely looking at the US market. But in India, we've had huge domestic flows of money into equity, which has sort of, outnumbered the institutional positioning. And therefore, you've actually seen it go much higher. What I think is happening over here potentially, I did think that maybe the best is done at the peak of January, but the last 3-4 days of trading action has opened up one risk that maybe as we are outperforming, as we go into early January, the Nifty could make a last attempt to head towards the top end of this pattern, completing what could be an ending diagonal. So I'm marking this as ABCDE. Okay. So this would be a 5-wave structure where wave E completes at the top, and then we probably join the other equity markets on the way down. This is how I am seeing it. It's also possible we don't carry that far. This most recent bounce only ends up at 61% retracement, which means around 18,460. Okay. Yeah. If we don't go beyond that, it is possible that we peak out there and join the other markets on the way down from this retracement itself. But I'll keep it open for the next week or so to allow our market to actually do whatever it wants to on the upside, and then take the trade on the downside as it starts to unfold.
So it sounds like to me what you're looking to do, Rohit, is you're looking to sell any substantial rally in the Nifty, pretty much.
That's right. That's right. Yeah.
All right. Well, Rohit, I want to say, it's always great meeting with you. I love the way you work. I love the way you look at charts. Very traditional plus you're adding wave counts. It's really a great way for people to view the markets and traders to view the markets. If I want to learn more about what you do, where's the best place to find you?
So people can find me on social media at India Charts is the Twitter account that they can start following. And they can, of course, visit our services at indiacharts.com. We do multiple things from, mentoring to, writing my market analysis on a daily basis. So the daily posts are there for people to read and follow.
Great. Well, I appreciate you being here and being part of the Trader Summit community. I know having you involved in our bigger events has been great. So thank you very much for joining us. And I want to wish you a happy new year. And I look forward to catching up with you in the beginning of 2023.
Thanks a lot. Happy New Year to you and to all the Trader Summit community. Thank you.
Thank you. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.